everyone, and thank you for joining us. We're excited to welcome Omar Ayales, who is the Chief Market Strategist and Trader at Gold Charts R Us, a weekly trading service that achieves gains by trading stocks, bonds, and commodities using correlated technical analysis. Mr. Ayales, thanks for joining us. The floor is yours.
Thank you very much, and welcome everybody to the Money Show and to my presentation. In today's presentation, I'm going to be showing you, I'm going to be charting, as the title suggests, the path for gold and silver, where we are, what has been happening after this, after the very harsh year, and what to look forward to and what to expect, and why, most importantly. So today is day 2 or 3 of the Money Show. So I'm assuming that most of you that are listening to this have already seen many opinions and many charts and analysis regarding where we are with gold and silver. I am trying to bring to you something different, a different optic that's going to be showing us through charts and through correlations and through key ratios between different markets, where we are in the current cycle in gold. And once again, what to expect moving forward, how to balance your portfolio so that you can take advantage of what's cheap and what are going to be the trends in 2022 and beyond. And I always start my presentation figuring out where we are within the macro picture. Okay, so basically the macro picture, the macroeconomic picture, is basically where the world is at. From a fundamental point of view and a bigger picture point of view in today, where we are, of course, as everybody knows, we've of course been moving away from a pandemic. Different variants have created have replicated, better said, some of the restrictions and some of the ways that we adopted after the pandemic, the COVID-19 pandemic broke out last year. However, I do see that a lot of those fears and restrictions are downtrending in a way as the world becomes more comfortable with life with COVID. So it does seem that this reality is here to stay. And we're not going to see it go anywhere. It's not going to cease to exist. And it seems to me that what's starting to happen is people just starting to become comfortable with the idea that this is here to stay. As we see this happening, I believe that there are many things that are going to be shaping. Of course, there's still uncertainty is still going to linger. Okay, and that's going to maybe have a push towards safety. Of course, it also means that longer term, or the economic recovery could continue to gain steam, and we can see some of the effects of that. We'll go into those as well. So the macro view, one of the charts that I tried to look at that tells me what's going on in the world is the 30-year yield on a U.S. Treasury. Okay. One of the reasons is because the 30-year yield, the 30-year U.S. Treasury is seen to be one of the safest assets out there to park money longer term. Okay, it's an asset that is being purchased. It has always been purchased by pension funds, money managers. It's always a big part of the portfolio, and it's something that is going to offer you safety and low volatility. Although in the recent past that has not necessarily been the case. Interestingly, this 30-year yield has been declining, okay, ever since in the early 1980s, 1981, when long-term rates peaked at over 15% a year. Ever since then, they have been in a steady decline. In past presentations, I've shown a chart since the 1980s, but sometimes you can get lost with the movements on such a big chart. So I've cut that a little bit and showing the chart since 2005, this first chart that I'm showing. And you can see this chart, the first on top, you can see it's the 30-year yield, and you'll see that it has 2 lines. Okay, the blue line, which is our mega trend that we have identified, and it's an 80-month moving average. And interestingly, since the 1980s, since interest rates peaked, and eventually started to fall and broke below this 80-month moving average. It has stayed below that moving average since. Is a 40 plus year downtrend, okay? So the blue line, you're going to see, it basically gives you where that trend is currently at. So you can see the 30-year yield, okay, is resisting below that level. It has not been able to peak above it. And that actually shows a sign of a sign that weakness, longer-term weakness in yields prevails, okay? This means that it is very likely that although we could still see the 2021 highs in yields tested, okay, which is on the 30-year around the mid twos, okay, it is more likely that we're going to start seeing it fall further, okay. You'll see that the charts below are two leading indicators that I usually use to try to identify momentum, what's happening with this chart in the medium term and longer term. You can see that the first leading indicator shows the medium term, and it shows that it has been falling from a peak that it reached in 2021, and it has been the highest peak since 2005, so over 15 years. You can see that it has been falling, showing the momentum has been waning, falling, confirming that there's strong resistance at key levels. The indicator below is more of a long-term indicator, okay? These are measuring the long moves. This indicator is showing us that actually the 30-year yield over the past year has been very strong, okay? But that strength has peaked, and it's very likely that we're going to start seeing an unwinding of that, okay? Longer-term dynamic for the 30-year yield, according to this chart, is that it will continue to possibly decline first and before it actually has the strength to break above meaningful resistance, which would be the blue line, okay? Notice that that blue line is near the higher twos, or around 3%. Now, being that the long-term yield seems to continue on a downtrend despite the bounce up of the past year, okay? What does that mean, okay? And if yields are falling while inflation is rising, now what does that mean, okay? That's even crazier. You know, there are one of the rates that we follow are real rates, and real rates I define as when you use yields, okay, that are yields that are commonly used, that are the standards, like the 30-year yield or shorter term yields, less the rate on inflation. That number, okay, if it's negative real yields. It means that even though you're gaining a yield on a yearly basis, the purchasing power of your money is falling at a faster rate than the yield that you're making, okay? So that is negative real yields. Most of you already, a lot of you I'm sure know what this is all about, but for those of you who don't, it's important for the next part of what's coming in my next charts. Okay, the other yield that is very important in my view, that is also telling me that yields overall are gonna start falling again, is the 30-year mortgage rate. The 30-year mortgage rate basically is the rate that anybody who's buying a home is given. So basically a long-term mortgage rate. This mortgage rate coincidentally is out of the US, not in Canada. The 30-year mortgage rate, you see that it has been declining steadily since 2010. This chart is 2010 again. This chart has two leading indicators, a medium-term leading indicator and a long-term leading indicator, okay? Coincidentally, in this 30-year mortgage rate, you can see that both leading indicators are at high areas, saying that the recent rise of the past year has been strong, but that rise is nearly over or nearly overextended, okay? We see that downtrend showing in the 30-year yield, which is that gray line, okay, from the 2010 peak, and even that goes through today, is still up there. And it is likely that the 30-year mortgage rate will continue to resist below that level. And now that means a lot of different things. That means borrowing costs, could remain cheap despite the whole talk about tapering and raising rates and this, that, and the other. It's telling us that it is likely that the mortgage rate will remain cheap, which means eventually the real estate market is probably going to stay hot, which means that yields overall are going to remain under pressure. which means that probably safety assets, could eventually start rising against risk assets or growth assets. So going back to this negative yield situation, okay? Negative yields are very bullish for gold. And the reason why they're very bullish for gold is because, well, one of the reasons people tend to favor, for example, bonds as a safety asset versus gold is because bonds traditionally offer you a yield. Okay, so you buy a 30-year US Treasury, it pays you a certain yield every year, and then, you have your safe, real safe asset, okay, yielding something every year. You can also hold other safe haven assets like gold or even the US dollar. Okay, however, gold nor the US dollar pay out anything. They don't pay off anything. Okay, they don't pay a dividend, they don't pay a yield. They're just a yieldless asset. Okay, but whenever those real yields tend to be low or negative, it ends up being a catalyst for gold, because ultimately, why hold the bond if it's not really giving you a yield? If the real yield is negative, then investors tend to be more open about holding other safety assets that could eventually appreciate in value, such as gold. Traditionally, of course, gold being, the safe haven of choice throughout millennia. Okay. And so this chart, notice this chart is since 1967. So it's a very long-term chart, 1970. And the top part of the chart, you see that it is basically a long-term chart of gold. We see that gold has been, on a steady up move since the 70s. Okay, since the market was opened and led to be traded freely among people. Okay, and markets. That's what happened back in the late 60s, early 70s. And since then, you see that basically gold has been rising. Of course, that has been going up and down, but, the longer term trend, the secular trend has been to the upside. The chart below, okay, you basically see what I called the real rate. Okay, so in this particular chart, what I'm using is the 90-day T-bill rate, which a 90-day T-bill arguably is probably one of the safest assets. And usually it has also a lower yield than longer term instruments. So you have the 90-day T-bill rate less the rate of inflation. The rate of inflation for this particular chart, I'm using the CPI out of the US, the Consumer Price Index. So if you grab the rate of the 90-day bill less, okay, the CPI number, you're going to get a negative number. And you see that basically in this chart below, also since the late 60s, early 70s, you see that the zero line is the zero rate. Okay, you see that since the 80s, the real rate has been falling consistently. Okay, you see that in 2008, it fell precipitously to about like -4. And today, we've actually broken below those lows, nearing what the lows were back in the early 80s when gold peaked. Okay, and that major peak when also interest rates peaked. So this is telling us that negative real yields are bullish for gold, will continue to be bullish for gold, and seeing the outlook that the yield, the longer term yield, is going to be falling, it is very likely that that situation will continue to foster negative yields and will continue being supportive for stronger gold. So I'm going to now compare gold to different markets, so we can see relative to other markets historically where gold has been, how it has reacted, and where it is today. So for example, this next chart, okay, shows a ratio between gold and crude oil. Okay, basically gold divided by crude, okay, gives us a number. That number we plot throughout history. This chart is 2004 with a long-term leading indicator below. And you can see that since 2008, gold has been quite stronger than oil. Okay, it has been in an uptrend. When the ratio rises, it tells us that gold has been favored against crude oil. When the ratio falls, it tells us that crude oil is favored or has been favored or is being favored against gold. So the longer term uptrend tells us that gold has been stronger than oil over the past 10 years or more, the decade since the 2008, since earlier than that. Okay, but you can see that this uptrend is between the 2008 and this year's low in 2021. If you see the leading indicator below, okay, you see that the ratio had risen to a high, and that coincided with the peak in 2020 of the ratio. That was basically the peak of gold of last August 2020, when gold peaked around almost $2,100. Since then, gold has been falling, as many of you know, especially if you've been invested in it. Okay, and resources and energy have actually been rising. This fall since 2020 shows exactly that. However, you can see that this year, it seems that the ratio is forming a bottom above this 2008 uptrend. That bottom, if you look at it together with the leading indicator below, that has been completely bombed out at an extreme low, at the most extreme low it has been in over 20 years, it tells us that the ratio's down move is probably overextended, and it's probably about to move up again. That means that gold is going to be probably favored against crude oil moving forward. Okay, this not only is important for gold as a commodity or crude as a commodity that we use, but gold being an asset that is usually bought for safety, okay, against versus crude oil that is usually an asset that rises when there's a stronger economic recovery, when there are boom times, when usually when there are growth prospects and that sort of things. Okay, so basically this dynamic between gold and crude oil is very interesting because it allows us to see what is actually going on in the world more than just what the commodity is doing. What is the actual sentiment? What is going to be favored moving forward? Is it going to be safety asset or is it going to be risk assets? This chart makes a big, very strong point that moving forward is very likely that safety assets will be favored over risk or growth. This next chart shows a similar picture, but with different elements and with different players. We see this is basically another ratio, okay, between silver and copper. Now, one of the interesting things about silver and copper is that they're both highly used industrial metals. Okay, this means that both of these tend to be used for in boom times. Okay, if there's construction, if there's growth, if there's an economic recovery, silver and copper are elements that are used in a lot of things. Okay, so they're high industrial use metals. Okay, but it does happen that one of them tends to be outperform the other during different times, different dynamics that are going on in the world. You see that this chart is since 2005. The top part of the chart is the actual ratio. The bottom part is a leading indicator. Okay. And basically the top part of the ratio, you see that the most recent peak in copper and I'm sorry, in silver of last year, that was when the ratio peaked at the top side of this sideways band. Okay. Since that peak, when silver reached about $30 and then has started to fall since, together with gold, and copper has actually strengthened in an amazing bull market that persists to this day, it shows that copper has been stronger than silver. But yet again, and similar to what we saw in the previous ratio, you see that the ratio is reaching the bottom side of that same sideways band. It's reaching a key support level. It's looking like it's bouncing at that key support level. And coincidentally, it's happening just as the leading indicator below falls to an extreme level that has coincided with bounce ups that favored silver the past nearly 20 years. This chart is telling us that it is very likely that we're going to start seeing silver outperforming copper moving forward. Why? The reason is that silver is not only traded as an industrial metal. As many as you know, silver is like gold's little sister. It's the poor man's gold. It also rises when gold rises. It's also sought out as for safety, and it's also traded as a currency. It has been for millennia. Again, same with gold. Now, I do believe that As the world continues, as the global economic recovery post-COVID continues to develop, and we start seeing gold, and we see gold maintain its luster, it's basically a perfect situation for silver to thrive. It's a double thruster pushing silver up, that could be explosive. You want to definitely be in silver. So we also compare gold to the Dow Jones Industrials. You see, for example, this next chart is again a 20-year-old chart, and it's a ratio between gold and the Dow Industrials. This measures what is stronger, gold or stocks, industrial stocks specifically. Okay, you see the chart had a really when it rises, it favors gold, and when it falls, it favors stocks. You see that the ratio had a very bullish rise up to 2011 peak. That was basically gold's bullish rise from the early 2000s to the 2011 peak. Most of you who were in the gold market then, I'm sure remember it. Was a wonderful rise favoring gold. But since peaking in 2011, you can see that dynamic shifted completely, and it actually has been falling for the past nearly 10 years or 10 years. This basically tells us that stocks have been favored over gold for the past 10 years. Now, the longer term dynamic, you see that right now, you see a little bit of a bottoming action happening right above this support, which is a 18 plus year long uptrend, okay? Just as the leading indicator below is also at an extreme low. The extreme low does tell us that stocks remain stronger. It does tell us that stocks have been stronger, but it also is telling us that the down move is nearly over. Some consolidation above the uptrend and support is probably likely. And moving forward, we shouldn't be surprised if gold starts to outperform stocks once again on a longer term basis. You see this next chart shows the HOI Index. Okay, so gold can rise in different circumstances, and really depend and really it will depend on how, when the move of gold is coordinated with other precious metals, with other safe haven assets, with the HOI Index, which is basically an index composed of gold miners. When you see silver, when you see others that are looking, when you see those ratios that are bottoming in favor of gold or in favor of silver, okay, all of that is telling us that there is a coordinated push towards safety. You see this chart of the HOI, even though it has been taking a beating the past year, okay, it has been uptrending since 2001, okay, and it basically, even though it peaked in 2011, similar to the charts that we've been seeing in the past, and we saw that precipitous decline to the 2016, 2015 lows, since then, it has been uptrending once again, okay? Noteworthy that HOI, similar to silver, even though gold has surpassed last year, and it's currently near the 1800 level, which used to be the highs of back in 2011, we see that HOI is still about half the way where it was back in 2011. Back in 2011, it had reached 600 points, and right now is at the 250 level. They're testing it. Silver is the same. You see copper that rose to new highs. You see tin, you see aluminum, you see a lot of the industrial metals reaching new highs or testing old highs. But silver remains less than half of its all-time high, above $50. So that in itself should be telling us that both of these assets have a lot of room to recover, and the upward potential is very bullish for the gold universe overall. So though these ratios, everything is all quite fine and dandy until it's not. And the past year has been one of those for the books as to the down move and the pain. It has definitely extended a bit longer than I have anticipated. Not that that necessarily means anything; it just has. But according to this chart, this next chart, it actually tells us that gold is doing what exactly it should be doing. Okay, So you see this next chart is also from a very long-term chart since the 70s or late 60s. And it shows us that gold primarily has two different major long-term cycles. One is a 7-year cycle, and the other one is an 11-year cycle. Okay, the 7-year cycle basically is pertaining to bottoms. Since the 1969 low, every 7 to 8 years, gold has shown a major bottom. You can see it 69, you can see it in 1976, you can see it in 1985, you can see it in 1992, you can see it in 2001, you can see it in 2008, you can see it in December of 2015. And if you count 7 years plus since December 2015, it tells us that gold's major cyclical or secular low, okay, is probably going to happen sometime in 2022 next year. Okay, so what does this mean? This means that we could continue to see downside pressure in gold. Just this past week, whoever's following gold on a daily basis, is no secret that has been taking a big beating. And we could continue to see volatility at these levels. We could continue to see major support levels tested. We could continue to see softness in the miners. We could continue to see softness in silver. So even though all these ratios and all these indicators are telling us that moving forward, gold should be favored versus risk assets, okay, it is also telling us to be cautious because timing, timing plays its thing. And not just because something is inevitable, it means that it's imminent. And in this particular case, I do believe and I do see that the rise in gold is inevitable, but I do have to remain, and we all should remain patient because it is definitely not imminent. And according to this, the 7-year cycle in gold, it's telling us actually that we could endure some more weakness. Gold could remain under pressure for a bit longer and into 2022. However, it is noteworthy that the bottom that will emerge in 2022 will be the bottom of the next cyclical and secular up move. Remember that the other cycle that this chart shows is the 11-year cycle. It shows that every 11 years since the 1969, gold basically has shown a major peak. And the more recent one being the 11-year cycle telling us that the next major peak in gold is going to be 2026. That means that we could see gold develop a secular and cyclical up move, bottoming in 2022, this coming year, from now into next year. Again, it's timing is tricky, and we have been taking advantage of weakness to buy positions and to position ourselves, and we always recommend everybody to do so as well, because right now is the moment that you should be buying or holding if you have been buying over the past year, because we are very close to a low, and the up move can prove to be a handsome one down the road. You want to definitely be in it. Some other aspects that are important to consider, like the US dollar index. The US dollar index tends to move opposite to gold, that they can move together, and they have. For example, like the 2018 up move in gold bull market that lasted through 2020 was very much coordinated with the US dollar. Yes, gold lasted longer than the dollar, but ever since they have, they pulled back. The dollar peaked in March, gold peaked in August. The dollar bottomed in January, gold bottomed in March, and they've both been uptrending ever since. The dollar has been obviously notoriously stronger, and its strength is basically also putting downside pressure on gold. You see that this next chart, that is also a nearly 20-year chart, you see that the dollar this year in 2021 has been bouncing up from this key support level near the 89 to 90 level in the US dollar index. It has been rising, and it actually broke above a 40-month MA, which is a mega trend, suggesting that the dollar could not rise to the top side of this sideways band at the 2020 highs, which is around 103. Of course, that rise would be excruciating for currencies and many of the assets. It is a safe haven play as well. You see the leading indicator below is rising and picking up steam, telling us that the dollar is definitely the rise is here to stay, and we should see a higher lows and higher highs. Look at the Canadian dollar. It tends to move inversely to the US dollar in many circumstances. And you see that it has basically also, it has reached a high level and it has resisted at that level and is starting now to downtrend. Okay, even though the leading indicator below has been rising, you see that it likely peaked and it's now moving down. It's yet to be seen what is going to be the lower level. Right now, it's showing some support at 78 cents. Okay, but it could easily fall back to this 70-cent support level. Okay, and one of the reasons that could happen is not only strength in the US dollar, but just weakness in the crude oil itself. As the Canadian dollar, it tends to move depending on the strength fueling crude oil and resources overall, being that it's such a big part of the Canadian economy. You see this chart, this next chart shows crude oil by itself on a downtrend since 2008. It shows that the rise since the last year lows has been exponential, has been very strong, has been beautiful to be if you've been trading energy, okay? But it's also telling us that rise, the leading indicator below, is telling us that rise may have peaked already. And you see the little peak and the decline of the recent decline after the US and other countries around the world tapped into oil reserves, creating a renewed glut of oil in the world, pushing the prices down. It is yet to be seen if OPEC is going to react to that or if it's just going to keep things as is. But it is likely that we're going to see oil remain soft for the foreseeable future. That in itself could continue to put downside pressure on the Canadian dollar. So right now, the past year, even though I have been invested in precious metals, I've also been invested in resources and stocks, common stocks, tech stocks. And, that has been obviously the better performing part of the portfolio, even though gold has basically remained lackluster or falling. It's important to always keep gold in your portfolio. It's important to always have a diversified approach because the reality is that not everything rises and falls when it should, and you should be prepared for whatever is happening. You should adjust your portfolios and you should always be susceptible to big changes in paradigms as the one that we might be seeing moving forward, where we're going to see safety outplace risk. Using a combination of fundamental and technical analysis is key to successful trading. Not one single method is foolproof. Make sure you choose sectors that are poised to perform in accordance with your macro view. Fundamental analysis will allow you to pick positions wisely. Subscribe to news feeds of companies that you follow. Dial in quarterly phone calls or read the reports when issued. Subscribe to some newsletters like Gold Charts or Us and others. Take a look at debt reduction. Look at the increase in tax payments of companies, the dividend policy, forward guidance, study management, and try to understand their philosophy. Technical analysis will allow you to time trades of those positions more precisely. Identifying trends is the most important, but other chart patterns can help identify tops or bottoms. I use both to shape my portfolio and to keep my portfolio diversified, and I would recommend that you do the same. I've been invested a lot in the uranium companies. I've been invested in energy through uranium. A lot of the companies that I like, Next Gen Energy, Uranium Royalty, some of the companies in the gold realm that I like, a bigger company that is actually merging, doing a big merger that was just recently approved, the Kirkland Lake or Agnico Eagle. I think both of those are great companies. Even though they're merging, it's probably going to become a staple. I really like, from smaller companies, I like BlackRock Silver. I like Nova Gold. I think, these are companies that have, stellar management, stellar assets, good business plan. Then, as soon as the market, the gold market turns, are going to be probably the ones that are going to outperform the rest. So those are some of the positions that I like, some of the things that I've been invested in within tech. I've been with some of the e-commerce names like PayPal and Shopify. They've been great. And that's basically it. So if you have any questions, I don't know if we still have a few minutes for those. If you do, I would be happy to answer. Also, here's my email that you'll be able to see. Feel free to email me at any time, and I will send you this presentation. Plus, I will also throw in there a 1-month subscription for free to my service, which is a weekly service. That means you get 4 to 5 letters with showing these types of charts that I've shown for you today, with also specific recommendations as to when to buy, when to sell, and you'll get to see my entire portfolio as well. I hope you have a good day, and I hope this was a good information for you, and take into account so that you can improve your positioning moving forward. Thanks a lot, and have a great day.
All right. Thank you, Omar. We are out of time, but if you don't mind, I have one question for you.
Absolutely.
So today gold broke the technical support below 1770. What is the next level to watch to stay invested in metals?
Okay, so the levels that I've been watching basically are the March lows for me are key. The March lows in gold, which are at 1675, for me is basically the line in the sand as it pertains to gold. If that level is to be broken meaningfully to the downside, then we could see a correction, a deeper correction that could push gold into a lot lower. So my line in the sand is 1675. Of course, I've noticed the decline of this week, and it's breaking technical support. But I like to look, not only that, I like to look at the HOI, the 250 level, which is also breaking it. But since gold is not breaking its mega trend at the 1675, I'm still looking at it. I'm looking at continue to monitor HOI action. And I also look at $22 silver, which right now it's close to that as well. But the $22 silver, the 250 on the HOI, and the 1675, for me, those three are key. If those three assets break those levels, then I would be inclined to say that we are probably in a prolonged down move and maybe even bear market for the metals, for the precious metals.
All right. Well, thank you again. That was an interesting presentation, and we appreciate your time.
Thank you. It was my pleasure.
And thank you to everyone for attending. Our next presentation features Jonathan Chevreau on the MoneySense ETF All-Stars.